So to start, my name is Abigail, and I'm the Senior Partnerships Manager here at CanadaVisa. So I help facilitate webinars like these from our great partners like TD. And today's webinar is What to Know Before Buying Your First Home in Canada, a guide for newcomers. So we're going to start this webinar with a presentation by our guest, TD Bank, and then after the presentation, we'll have our Q&A period where you'll be able to ask questions via the chat, and then our moderation team will pull up those questions and we will get to as many as possible. I'm now very happy to introduce our guest, Darwin. If you've been to our webinars in the past, you may have seen Darwin before. He has a lot of valuable knowledge to share with you. He's a mobile mortgage specialist with TD and has been with TD for over a decade, progressing to different retail banking roles in the Toronto area. In his current role, he helps homebuyers with their home financing needs with a special focus on new to Canada. In his spare time, Darwin enjoys video games, cooking, learning new things, and all things tech. So we're very happy to have you with us today, Darwin. I'm now going to pass it off to you. So let's switch over to our slides. And I will pass it off.
All right, good morning. Thank you, Abby. Thanks so much for the introduction. Good morning to everybody in the chat. Thank you so much for tuning in. It's yeah, you mentioned I've had the opportunity to present this deck and presentation a few times in the past. Anybody returning for a second revisit, then welcome back as well. It's always really humbling and really cool to see the chat and see where people are tuning in from. Doing this daily, you can imagine the vast majority of clients I interact with are in my local community, more in GTA, Toronto, Ontario. We also do transactions or meet with clients and help, right across the country. And so, most of the people reaching out are from Canada, but to see people from, just on the current screen tab of the chat, I saw people from like Madagascar, Kenya, different areas in Europe, Africa, Alberta, Ethiopia, USA, California, just really cool. I'm just going to touch on some brief housekeeping. So we're going to keep Q&A until the end of the presentation. I have, in terms of just general feedback, people often tell me I can speak fairly quickly. So also with the Q&A, if there's a certain area you want me to revisit and touch on, feel free to ask and request that as well at the end. And with that, we'll jump into it. So today's agenda, we're basically going to touch on these topics at high level. In terms of the slide format, so a lot of it's kind of general high-level terminology and general information, and then generally following what's on the slide, I typically like to add a bit of my a personal spin or a little bit more additional information that I feel may be relevant for you that I like to pass on and share with my buyers as well. All right, so today we're going to generally talk through the flow of the following topics: understanding what a mortgage is, how to determine what you can afford, and the cost to consider when buying a home, understanding basic mortgage terminologies, TD mortgage solutions catered to a newcomer. Right, so this is just part of my intro slide. Nice to meet everyone. Okay, so what is a mortgage? So a mortgage is a loan that's used to finance the purchase of your home, with the property or the home that you're purchasing serving as collateral or security for that loan. It enables you to acquire property without having to pay for the full price of the transaction, right? So what that basically means is the mortgage is a financial tool or loan that you borrow from a bank for a certain portion of the home purchase price to finance that purchase. And it's the difference that's borrowed separate from the amount of money that you put in to purchase that home up front. Right, so the amortization period of the mortgage is the time it would take to pay off the mortgage, assuming no change to the payment amount or interest rates. And in Canada, people may choose typically an amortization period of 25 years. We do offer in many instances up to 30 years. And the longer the amortization period is, the more interest you will pay over the life of the mortgage. So just touching on so generally with a lot of loans, people will normally set up the terms of a loan initially upfront and expect that the terms of that loan will not change throughout the course or lifespan of the loan. That would be the case if the term and the amortization period were the same. In this case, so the amortization, you can think of it more like with the parameters set up front, so the interest rate, the loan amount, and the payment amount, it's the length of time it will take for you to pay off that whole loan in its entirety. But because a mortgage is a very substantial loan, the contract involved to pay it off would be very long. And in Canada, most people tend to get mortgage contracts for roughly, I guess it would be most common between a 3 to 5 year term. But most people are not paying off their mortgage within that 3 to 5 year length of time. And so that 3 to 5 year length of time is what we call the mortgage term. So the mortgage term is different than the amortization period. It's the length of time that you have your initial financing contract with your lender. You would pay off typically a portion of that loan, and the rate that you're paying off, or the expected time to pay off everything, would typically be made up of several smaller mortgage terms, and the total length of time would be the amortization period. Right, so costs to consider when buying a home. So costs to consider when buying a home, oftentimes people like to compare this to, generally if we need our own place to live, we have generally just primarily if, if we're going about it independently, we're generally going to compare the cost of renting your home versus buying a home. And people will tend to compare the costs of just looking at their lease or monthly rent amount and compare that to the mortgage principal and interest amount. So this slide goes to point out that the costs associated with buying a home go far beyond just the mortgage amount that we had mentioned. And because there's a lot of monthly carrying costs, but also transactional and costs associated with terminating or selling your home, and undoing a longer term buying transaction, you do want to take a lot into consideration when you're making such a substantial decision, right? So for example, when you buy a home and you want to sell it, there are costs involved like realtor fees, legal fees. There could be costs associated with timing when you're looking to buy and sell. A lot of people think that there is a seasonality to these types of transactions. So when you go about making such a large, substantial financial purchase, many people say this is, the biggest financial decision you'll make. You want to eliminate as many of the potential variables or reasons you may want to terminate or undo this transaction as possible, right? So upfront, you would want to really research where you want to live, what neighborhood or what area you like. Do you want to be close to schools, transit or shopping? What type of properties you want? Do you have enough money set aside? What your mortgage payments and so on will look like, right? So a brief example would be, it would be really unfortunate if you didn't do some of this pre-work up front. You purchased a home that you really liked, only to find out a year later that you decided that maybe commuting an hour and a half to work was something that you don't want to do, right? If that would be a really unfortunate reason to need to now sell your home, incur a lot of the transactional expenses of doing so, just because you didn't ask those questions up front and plan a bit more, right? So we want to eliminate as many of these unexpected or, controllable things as we can before engaging in a substantial purchase transaction. So some of the costs associated with buying a home can include your mortgage, principal and interest payments, property and school municipality taxes, your condo fees, home and condo insurance, utilities. So earlier when I was saying that you would want to compare your monthly carrying costs of owning a home to rent, I would kind of just stop it there with those 5 as the main kind of monthly typical carrying costs. But in a separate category, you also need to have a separate budget or accounted costs for unexpected. Whereas with rent, let's say that you wanted to terminate a rent contract. The worst case scenario typically may be that you may need to buy out your lease or something, right? But with home ownership, there can be much more substantial, unexpected one-off expenses for, say, water damage and leak, or home fire or theft, burglary, damage, vandalism, these things that don't happen monthly. But now that you're a homeowner and that's your asset, these are new unexpected costs that go above and beyond the typical monthly carrying costs that you should be mindful of and consider. Great. So here is a budget example of how you might want to look at costs of owning a home versus renting. Right. So again, if you were to expect that you might spend $3,500 a month, you wouldn't, or it wouldn't be prudent to expect that $3,500 is how much you can afford in just the mortgage, because here's a breakdown of what monthly expenses may more typically look like. Right. So from $3,500 in this example, your mortgage payment may make up $2,250. But on top of that, you'd have to pay maybe $300 in property taxes, $550 a month for condo fees if it's a condo type ownership, home and condo insurance, plus any utilities. This doesn't even count any subscriptions and things like internet or other things like that at home. And then on top of that, this is probably even a conservative value, but setting aside a prorated monthly amount for some of those emergency expenses we mentioned, right? So quickly you can see how a $3,500 budget as compared to renting sounds like it can be quite a lot, but a lot of that is comprised of a lot of the extra carrying costs of owning. And so this needs to go into our planning as well, just to make sure that you're comfortable maintaining your payments throughout the course of home ownership, while still being able to potentially set aside for other things like, saving, vacation, family, and other obligations that you may have. Right. So understanding basic mortgage terminologies. So mortgage interest rates. So a mortgage interest rate is the percentage or amount of interest that's charged on your mortgage, or it's the interest rate on the loan that you're taking out to buy the home. There are typically two types of mortgage interest rates. There's fixed interest rates, meaning the interest rate will not change throughout the entire term or mortgage contract. And then there's variable interest rates, where the interest rate can fluctuate throughout the term as the base interest rate changes. And for base interest rate, typically what they're meaning here is the prime interest rate, right? So each financial institution will have their own base or prime interest rate. Oftentimes it's very close to the same, if not the same. But for example, with a variable interest rate, if the Bank of Canada is or central bank, where you're taking out your mortgage loan, increases or decreases the overnight lending rate, the banks in that area will typically change their bank prime rate, which will affect the interest rate that's calculated on your loan. Here at TD, what that means is your periodic monthly or biweekly payment may stay the same, but the portion of interest and portion of principal paid with each payment after the interest rate changes will change. Will change based on how the interest rates have changed, right? So with variable rates, they're a little bit less predictable, but oftentimes they may sometimes be cheaper on setup than fixed rates, and so people may want to go with those options. Right, so now into down payments. So the down payment is the amount of the purchase price of the home that is not being financed. Some lenders have mortgage solutions tailored to newcomers, and they may have specific minimum down payment requirements. So this is to say, for example, if you purchased a new home for, we'll say $500,000, if you had set aside, say $150,000 to purchase the home, and it costs $500,000, you may need to borrow the difference or the delta of $350,000 in the form of a mortgage, and your down payment would be the capital you set aside, that $150,000 that you're putting into that home purchase. right? So note here in Canada, mortgage default insurance is required of putting less than 20% down payment of the home purchase. This amount is added onto your mortgage principal, or you can pay it as a one-time amount upfront, right? So what this is typically saying is if you're purchasing a home in Canada and the amount of down payment you have set aside is under 20%, you can still take out a mortgage for the difference to finance that home. But in that case, your lender has to add a additional insurance premium on top of the mortgage amount you're borrowing because they're incurring more risk and lending at a higher percentage of the home value in case home value in the market fluctuates. There's this extra cost involved and also an extra layer of underwriting or qualifying criteria that the lender needs to consider. Since default insurers in Canada, there's three primary ones: CMHC, Sagen, and Canada Guarantee. They each have their own different layer of underwriting and qualifying criteria on top of the bank's criteria that a borrower will now need to satisfy in order to borrow with less than 20% down payment. Getting pre-approved for a mortgage. So a pre-approval is when a potential mortgage lender looks at your finances and decides how much they might lend you and what interest rate they'll charge, subject to certain conditions. You may end up with being pre-approved for an amount greater than you want to borrow or less. This doesn't mean you need to borrow all of it, but as we mentioned kind of before, create a budget and make sure you follow it. So touching on pre-approvals, what I like to tell my clients doing an pre-approval with myself is that pre-approvals are generally completely non-committal. They are a credit check, but it doesn't mean that you have to go with the lender you're getting a pre-approved with. And it's also not a guaranteed, stamp of approval that if you're pre-approved for a certain amount, you will definitely be able to purchase for that price. I know that sounds a little bit kind of counterintuitive, right? But what a pre-approval basically does is it allows us to take a current snapshot of what your credit looks like, your actual current income documents, verify within our own policies that everything kind of adds up and aligns with what you're saying. And we will, at least here at TD, we'll look at approximate home values and approximate home costs for the home or for the pre-approval purchase price you're looking for, and gauge roughly how much we think that you can qualify for. Why this differs from a live deal or it's not a guaranteed stamp of approval would be because from the time you're pre-approved to the time you're purchasing, your circumstances might change, right? You may have changed job roles, you may have changed employment type, you may be purchasing a different type of home entirely, right? And also in the pre-approval stage, we're kind of just generalizing or estimating some housing costs. But just as we mentioned, many people on this call are from all across the country, all across the globe. Purchasing a $500,000 home in Toronto may look very different from buying a $500,000 home in, say, Edmonton or Winnipeg or Yukon or the Maritimes, right? And so the pre-approval benefits you in a few ways, though. It gives the advisor you're working with a good idea of how your numbers will look on a live deal, so that when you're looking at certain properties, I would be able to look at your paperwork, the pre-approval, and to say, hey, you know what, on the actual home you're looking at, I think you can probably borrow closer to this amount, right? They can also give you advice to say, hey, your target purchase price might be a bit higher. You need to wait until your income increases a little bit or come up with a bit more down payment and we can revisit to get you to that home you want, right? Other benefit of a pre-approval is often you will be able to book and hold an interest rate for a set period of time. With us, it's 120 days from the application date. So this rate, again, is non-committal. Doesn't mean you have to take it with TD, and doesn't mean that this is your final rate with us. What it does mean, though, is that if interest rates get worse, we'll honor that for you if it's booked and held for you for 120 days. But if you change your mind for rate type or if the market rates get better, of course, we're more than happy to update that and book a better rate for you. Right. So why get pre-approved? Pre-approval helps you to understand the amount you may be able to borrow and locks in your rates, which may vary from lender to lender. Getting pre-approved is not a promise that you'll be approved for the mortgage. Make sure you read and understand all conditions in your pre-approval. Right, so pre-approval is generally going to be done with a mortgage specialist like myself. I did want to mention as well, so a useful activity for anybody that's interested perhaps in getting a pre-approval soon or in the future is to, you can put it in your browser or search engine of choice, but I tried earlier, if you just type in TD Mortgage Specialist Locator, you'll be pulled to our website that allows you to look up a mortgage specialist within your area. In there, you can filter for language preferences, cities, and areas of coverage. If you're interested and want to follow up on a topic or anything with myself, you can reach out directly as well. But all of us are happy to help, and we can service you across Canada. So for mortgage prepayments, you can make additional payments to pay off the mortgage sooner. These are called prepayments and could be in the form of lump sum payments or increasing your regular payments. Mortgage lenders can have different prepayment options. Prepayment privilege is the max prepayment amount that you're allowed without paying a prepayment charge and will vary by mortgage lender and mortgage type. Right, so elaborating a little bit more on this. So what lump sum mortgage payment means is if you have a mortgage payment and loan set up and you're paying, let's say, $2,000 a month, and you've accumulated some savings or maybe got a workplace bonus or something, and you want to pay the loan off faster, maybe you want to take $10,000 and apply it against the loan on top of your regular payments. So this would be the lump sum payment on the mortgage. Now remember, up to this point, your mortgage typically would be up to date. Interest and principal payments and everything would be paid as they should be. So when you're making this extra lump sum payment of $10,000, generally it's paying directly against principal and there's no interest component on it, right? So the lump sum payments will pay principal faster than if you were to just wait for the same equivalent $10,000 of payments to go out in the next, say 5 months, because over the 5 months, interest is accruing against that $10,000 payment, where the $10,000 lump sum that's being applied immediately shouldn't have any interest on it, right? In terms of increasing your regular payment, so kind of same idea, just different way to apply it or different timing. So if you are paying $2,000 a month and you now decided, instead we can afford $2,500 a month, let's pay off the loan faster. Well, your interest is still calculated based on your amortization, your loan and interest rate. The interest is calculated and the principal amount is calculated based on that expected $2,000 a month. If now you're paying $2,500 a month, that extra payment is again applied more directly against principal. And so again, we could say that extra $500 is doing more for you than the $500 out of the original $2,000 payment that you're making. So prepayments go a long way in helping you pay your mortgage down faster and lowering your lifetime cost of borrowing. Right. So mortgage solutions cater to a newcomer. So this is obviously a very popular topic for a lot of us here in the chat. People are applying with plenty of different circumstances, whether you're on a work visa, study visa, applying for your permanent residence, thinking to move to Canada and having not yet. Maybe the case that, maybe you're originally a Canadian citizen, currently living abroad and looking to buy a home that you may return to in Canada. So really the call out here is that it's difficult to get into because all of these cases are a little bit more advanced. They're a little bit more individualized and case specific. But the bank and we have different lending solutions and programs set up for each of these. And so this would be a great reason to reach out to a mortgage specialist, not even just for a pre-approval, but for some guidance and information about each of these different programs. For example, if you are purchasing as a non-resident before you moved here, you may be limited to, with our programs, 35% down payment, which you may not want to do. That's a very large amount of capital you would need to save up to purchase. But if you instead waited to, say, get a work permit here, under a work permit, and there's some additional criteria of the length of time, expiry, and stuff like that. But with a work permit, you may be eligible to purchase, which is 20% down, or through our default insurance with even less, right? So for any of these cases that are a little bit more specific to your own scenario, feel free to reach out to any of us, and we would be more than happy to help. Right, so next steps. So TD can help you finance your first home in Canada with specifically designed mortgage solutions for newcomers. You may be eligible for a TD mortgage even if you have no Canadian credit history, provided you meet eligibility and credit criteria at TD. Right, so there's just a link here in the slides you can also follow up on and look at some of the additional information there that you can visit and kind of look into for additional information. You can request a call from a TD mortgage specialist to learn a bit more about your options after you've arrived in Canada, or potentially proactively as well.
Okay, great.
All right.
Thanks so much, Darwin. That was great overview with very helpful details. And we've had some questions from the chat and also questions that were pre-submitted. So we'll move now into our Q&A. And so if you have questions, continue to ask them in the chat and our team will pull them out. But we'll get started with a question. Well, just to start, a question that I saw a few times, just logistically,
Sure.
is this for the slides and recording. We will be sending the slides and recording to everybody after the webinar, so you can watch again and go through the slides more slowly if you'd like to and revisit things. So now a question from the chat. Is there a credit check required for pre-approval and then another credit check at the time of getting a mortgage?
Yes. Well, I was just addressing we'll answer that question. So with the pre-approval, there is a credit check involved with that, and then converting that pre-approval to a live deal, that is a yes or no. So how that works, or why that's the case, is it depends on the length of time from when you first get your pre-approval to when you purchase. Right. So of course, just as we said before, from pre-approval to live deal, your circumstances may change. The credit bureau also periodically updates. And so automatically, if there's new updates or new information from the credit bureau, this typically happens every couple months, maybe every 2-3 months kind of thing. So if during the course of your pre-approval to the time that you have a live purchase, if there's new information with your credit bureau, the credit bureau will automatically relay that update to our system, and that would typically count as a subsequent credit check or update, right? But if you're purchasing very shortly after, then typically no new credit check is required, and so there wouldn't be a duplicate credit check on your record.
Great. Okay, next question. This was pre-submitted. What documents will I typically need when applying for a mortgage as a newcomer?
Yep. So typically, for mortgages in general, we're generally going to need to get some form of income document proof. We like to typically separate that into an annual income document and then a current income document. So an annual income document may be, for example, like a Canadian T4, notice of assessment, or say a US W-2, something along those lines, or even a year-end pay stub. That will show typically how much approximately you earn per year and how much you earned in the most recent year to give kind of a good idea of typical earnings and consistency. And then a current income document may be more like a pay stub or bank statement with direct deposit. This is more to show that your current income aligns approximately with that annual income amount, and also that there is continuity, that you're still currently actively employed, right? So we'll need income documents typically. Then we're going to need to verify down payment, so how much money you have set aside, where that down payment is coming from, and that you have sufficient in order to start the purchase process, and that you've set aside funds for like closing costs and other things. Separate of that, of course, there's a credit check. Now, many people here may wonder, what happens if I don't have a lot of Canadian credit history yet, or how long do I need Canadian credit history? So for new borrowers to Canada or non-resident borrowers, typically we'll lean on additional information, like say a international credit bureau record, or if that's not available, we may want at least, in some instances or programs, maybe 1 year at least minimum of at least 2 to 3 credit trades within Canada. Or we may look at, say, 6 months credit card history for a primary credit card from abroad, and just look at the repayment history, the usage, the limit as a gauge of your borrowing habits. Right. So generally, I would say that that's more or less what you can expect as at least a bare minimum of what we'll need to apply for a mortgage.
Great. And then building on that a little bit on the credit piece, Rachel in our chat asked, how does a credit score in another country like the US work in getting approved for a mortgage in Canada?
Yeah. So there isn't, because credit scores and credit score systems, I believe, they may vary. And so the main thing that we would really be looking for is mostly the credit repayment history. And also any current outstanding debts that the applicant may have that we still need to consider, right? So of course, if you're moving from abroad, but maybe you still have a home or other assets from back home you haven't sold, or other loans or credit card debts and so on, then the bank's going to want to consider those monthly carried payments on top of what you may have outstanding and are applying for in Canada. And similar as we would look at credit repayment history here, we would look at the credit repayment record for where the applicant is coming from and take that into consideration as well.
Perfect. Okay. Let's see. Okay, this individual asks a question about affordability. What taxes and additional costs should I budget for beyond just the purchase price of the home?
Yeah, good question. So speaking, because it may vary case by case, again, mortgages and home buying can be complicated. So for example, if you're buying a new home with a builder, you may have like builder levies and charges for related to construction and other costs associated with that type purchase. But generally high level at minimum, I would say on purchases, you'd expect to pay land transfer tax, potentially both provincial and federal, and at least some legal fees to the lawyer that's helping you with closing and registering the new mortgage lien. Those would be your primary closing costs, right? But in some instances, you may, like if you're buying a resale home and the seller has already paid the property taxes for the rest of this year, you may need to, for example, pay prorated property taxes back to the seller for the rest of the year from the time that you're moving into the home, right? So there may be some additional miscellaneous costs involved as well, and new build costs if you're purchasing a new build. But at minimum, I would say you'd expect at least the land transfer tax component on purchase and realtor fees, and lawyer fees, legal fees.
Right. We had a few questions around age and eligibility. Is there an age limit for obtaining a mortgage, and does age play a factor?
Yeah, great question. Generally, there isn't any kind of hard set rule to limit or restrict lending if someone is older, younger, that kind of thing. There is, I would say, a degree of reasonability that needs to kind of make sense for underwriting, just so we understand the applicant that's applying, and that the deal itself is reasonable. So, for example, if something seems a little bit atypical, let's say someone that just finished school is purchasing a very substantial value home, the bank may want to know, like, of course they would be eligible to purchase, but the bank may need an understanding more of how the applicant has perhaps very vast savings to purchase that's not normal of that life stage, that kind of thing. So we may ask a little bit more questions to kind of understand the scenario more. But there isn't a age limitation to say, after a certain age you can't get a mortgage, or you can only get a mortgage of a certain size. and in reverse as well. There isn't a threshold based on you being too young or too old.
Great. Okay, another question that was pre-submitted. What are some reputable platforms and websites that home buyers can use to search for properties in Canada?
Yeah, great question. So I can't say that these would be the best, but I can say that just personally, just through exposure or what I typically use, I like to use Realtor.ca. I also use Zillow. I also use House Sigma. But these genuinely, I don't know if these are more dominant or used more regularly more in Ontario, and if maybe in other provinces some are more actively utilized. But there's a lot out there. I would say, especially as a new potential buyer, though, in terms of finding listings and stuff like that, it may be a good idea to maybe ask and connect with a real estate agent that can start sharing and vetting listings for you that's catered a bit more to what you're looking for, and they can also kind of give you some references for sites as well.
So we had a few questions around this next topic. Do I need Canadian citizenship or PR to buy a house, or can I purchase a home while holding a visa or temporary status?
Yeah, absolutely. So you can absolutely purchase a home while holding a visa status before becoming a PR. For example, one of our programs would be if you're on a work permit and everything else is in good standing, you have good credit back home or good Canadian established credit history here, and your income qualifies, everything aligns with our typical lending policies, and your work permits. Now this could be subject to change at any time, but as of today, believe it's as long as your work permit is still valid, at least 183 days from the closing date of the new purchase, then you would be fine to proceed with that transaction, right? But yeah, these are one of the scenarios where I was saying it's better to connect with someone individually and explore further, because policies are subject to change, and every case is a little bit different.
And on that note, we've pinned and shared a few links. So there's a TD mortgage affordability calculator that you can visit that's pinned at the top of a chat that can help you understand what you can afford. And then mortgage specialists from TD Link that we've shared in the chat, where you can find and request a meeting. And then a link to what a TD mortgage advisor is and getting more information on that. So feel free to visit those links to learn more. And as Darwin said, speaking to someone about your individual situation is the best next step. Next question that was pre-submitted: can gifted funds from family members be used toward a down payment?
Yeah, absolutely. Commonly, people always joke these days and call it bank of mom and dad. We see it very often, though, in purchases these days. Gifted funds can definitely be used to help with purchases, and it's very common.
Great.
There's no, in many lending policies, I would add, there in some instances there may also be like kind of no restrictions on that, right? So it could sometimes comprise the full down payment, may be gifted, and that would still be fine for lending in some instances.
Great. Okay, and then I think we'll wrap it up with this last question. I know we just spoke about this a little bit, but in terms of next steps, can you just note for people that are in both outside of Canada and then in Canada what their best next steps would be, whether that's doing their own research or speaking to an advisor, so both pre-arrival and then people who are in Canada already?
Yeah, for sure. I would say, I mean, it's always good to get a second opinion or to do your own research, and we say things like that a lot. But as far as pre-approvals go and speaking to someone, reaching out to a mortgage specialist, because a lot of us have been doing this a long time, we may be able to give additional insights or things that you haven't thought about before. So I think that a combination of both would be the most practical. But of course, just restating that reaching out to a mortgage specialist is, you don't need to feel pressured that you need to work with the person you reach out to. You can reach out to several. And it doesn't mean that you have to be looking to purchase in the very, very near future, right? You can just ask for some free information, free advice, We're happy to give quotes, run numbers for you on your current scenario, and steer you in the right direction as well. And to complement that, by all means, do your own due diligence, additional research as well, just to make sure you're getting as full a picture and answering as many questions as you can. More information won't hurt.
Great. Great advice. Thank you so much, Darwin, for presenting and then answering so many of our questions. As I noted, you will be receiving an email with the slides and the replay video, and then some additional links for those TD pages that we've noted throughout the presentation. So hopefully you can join us again in the future. And thank you for coming today. And big thank you to Darwin for that presentation.
No problem. Thanks for having me, Abby. Thank you, everyone, for tuning in, and look forward to chatting with you soon.
Chat soon. Bye, everybody.
Bye.